Welcome to EKO201E, Economics. I'm Chris Hannum, and this will be lecture 17 on growth and development. Now, the illustration that you have here, to take a look at closely, is intended to represent the tangible possessions of a typical household in one of the wealthy countries in the world with a higher standard of living, the United Kingdom. And then down below, along with all of these possessions, these kinds of things which we might say don't necessarily add up to much in terms of quality of life, those GDP of 36,000, child mortality rate of only 0.5%, and high school enrollment rate of 98%. You can see that high school enrollment rate is high, that the child mortality rate is low, and this goes along with, in this particular case, a high GDP per capita and a lot of stuff. This family appears to live quite well. On the next illustration, take a look at the same typical family in Mexico, presented with their living accommodations and all of the goods, the bundle of goods that a typical Mexican family would be likely to have and likely to consume. Now, Mexico is a middle-income rather than high-income country like the United Kingdom. Mexico is not by any means poor. It's a middle-income country with standard of living similar to the standard of living in Turkey. Now, GDP per capita here is 15,390, much less than it is in the United Kingdom. And you can see from the illustration they seem to have a bit less stuff. But they don't live, it appears, too badly from a physical, tangible goods perspective. However, the child mortality rate as compared to the United Kingdom is higher, 3 times higher. 1.6% of children die before the age of 5, as opposed to 0.5% of children that die before the age of 5 in the United Kingdom. Also, the high school enrollment rate, the percentage of teenagers who do attend high school, in Mexico is only 71%. Whereas in the United Kingdom, it's 98%. So we can see that this child mortality rate rises as GDP is reduced. And we can see that the high school enrollment rate rises as GDP rises. Middle-income countries tend to have lower educational attainment rates and higher child mortality rates than do high-income countries. But note, the difference isn't too extreme until we compare in the third illustration a typical family in a poor as opposed to middle-income country. Now, when we say a middle-income country as opposed to a high-income country, this actually refers to a pretty large and diverse group that could have GDP per capita anywhere between 2,000 or 3,000 up to 30,000. Now, Mexico might be right in the middle of that, but there could be other middle-income countries that were a bit poorer and other middle-income countries that were a bit richer. Mali is well below that threshold to be a lower middle-income country and is one of the poorest countries in the world. See, the GDP per capita, and this is real GDP, when we've corrected for the fact that goods may be cheap in Mali, is very low. Only $1,040 per capita. And as you can see, the living space and the typical possessions of the typical family in Mali, they have much less than the typical family in Mexico does. You can also see now in Mali, the child mortality rate, that is the percentage of children who die before the age of 5, is 17.6%. When their GDP is less, that may not say anything about things like the quality of their marriages, but it does say that they're not able to afford things like health expenditures for children that would cause the infant mortality to be lower. Also see that high school enrollment is only 31% instead of 71 or 98%. Now, given that we have such huge diversity in standard of living across countries, where Mali is so much poorer than Mexico is, even though Mexico is poorer than the United Kingdom is, and because Mali is so much poorer than Mexico is, children in Mali are so much less likely to survive to the age of 5, Why is it that Mali is so poor? What is it that we could do to cause Mali to grow, to become at least a lower middle income country, and begin a trajectory to try to reach the standard of living, and therefore the infant mortality rate that they have in Mexico? Or what could be done in terms of public policy, economic policy? How could we make Mexico grow so that Mexico could catch up to the United Kingdom? First, to look at some stylized facts about incomes and growth in different countries around the world. We have here, on the one hand, GDP per capita in a subset of different countries in 2012, and then we have GDP per capita as it has grown from 1970 to 2012. And these countries are sorted by that growth rate, as opposed to GDP per capita in 2012. So the country at the top isn't the richest country. The country at the top is the country that has had the most rapid economic growth per year since 1970. That country is China. China has had a 7.5% annual growth rate since 1970. And that's more rapid than any other country in the world over that span. Other countries have grown, but they haven't grown at the rate that China has. India has grown 3.3% per year. The United States has grown 1.8% per year. Argentina has grown 1.4% per year. Now, when we see these GDP per capita figures, we can also see that there's a lot of divergence. Singapore, for example, has 61,000 per capita, but China has only 9,000, almost 7 times the GDP per capita in Singapore as in China. We also see that Saudi Arabia has 31,000 GDP per capita, even though their growth rate is very low. So Saudi Arabia's GDP per capita of 31,000 is much higher than it is in China, for example, in spite of the fact that Saudi Arabia's GDP has not grown rapidly since 1970, while China's has. In fact, because Saudi Arabia's GDP over the past 42 years, illustrated here, since 1970, has grown only at a rate of 1.2%. Saudi Arabia, as compared to Singapore, was the most prosperous country on this list with the highest GDP per capita. Saudi Arabia in 1970 was better off than in Singapore. But now as of 2012, GDP per capita in Singapore is twice as high as it was in Saudi Arabia. It isn't just the case that some countries which were rich have not grown fast and other countries have been able to surpass them, such as Singapore growing rapidly and surpassing Saudi Arabia. We also have, if we go back to 1970, a subset of countries that were very poor, such as Chad, India, and China. If we go back to 1970, these countries had relatively comparable GDP per capita. However, China has grown very fast since 1970. And Chad, in large part because of civil wars, has grown very slowly, hardly grown at all. As a result, China is no longer a poor country. They're no longer a low-income country. As of 2012, China is now a middle-income country, whereas Chad definitely remains a low-income country, like Mali in our example, whereas China now approaches Mexico in our previous example. So 2 lessons that we can draw from this are, first, that countries which are poor are not necessarily doomed to remain poor forever. At one point in time, well before 1970, Singapore was in fact a low-income country. But Singapore has grown over a long period of time such that it is now among the richest countries in the world. China, since 1970, has gone from being a very poor country to a middle-income country. We can also see that just because a country is poor, and we might imagine that a poor country has certain advantages in exports like cheap labor, we can't assume that these poor countries will automatically grow due to those competitive advantages. Some countries, such as Chad, have clearly remained poor while other countries have grown. Some countries have failed to do so. We can also see that the fact that certain countries are high-income countries does not mean that they will always remain high-income countries. If we go back 100 years, well before the beginning of the data in that table, Argentina was among the high-income countries, among the wealthiest countries in the world. But Argentinian growth rates over the past 100 years have not been high, in large part due to macroeconomic mismanagement that we may come back to in later lectures. And because Argentina has not grown rapidly while other countries have, many countries that were previously poorer than Argentina have surpassed Argentina in GDP per capita. And Argentina is now a middle income rather than a high income country. The same trajectory is one that Saudi Arabia has been on. Although it may still remain a high income country, it's no longer, relatively speaking, as well off as it was in 1970 due to low growth rates relative to other countries in the world since 1970. So the questions we try to look at in this chapter are, first, why are some countries rich while other countries are poor? Why is it that Singapore is richer not only than China, but also than Chad? Why is it that some countries like China have been able to grow quickly? And why is it that some other countries like Chad seem to be stuck in some kind of a trap where they're simply not able to grow and they're not able to catch up? What explains this? And what policies, maybe policies that China has followed, could Chad follow to try to pursue the same growth trajectory that China has had? What is it that China did to get that rapid growth? And can other countries do it too? What is it that Singapore did in order to get that rapid growth? And can other countries do that too? What is it that caused Argentina to lag behind over the past 100 years? And what kinds of things that Argentina did can other countries avoid? What lessons can be learned from Argentina's failures? Now, as we mentioned, as one of those key principles of economics back in the first lecture, we said most economists agree that the fundamental determinant of standard of living for a country is productivity, its ability to produce goods and services. So if the ability to produce depends on productivity, and the ability for a country to spend and consume, standard of living depends on this productivity, what is this productivity, and how can we improve it? Now, this productivity we calculate in a very simple way, for a simple explanation, as just the amount of output divided by the number of workers, or the number of labor hours that are used in that economy. That's raw labor productivity. Say that workers' ability to consume will be primarily driven by those workers' ability to produce. So public policies that we might want to put in place to cause, say, Chad to grow like China has grown should be policies that are intended to make Chad's workers more productive so that Chad can produce more goods and services, therefore have more goods and services available to consume. Whenever productivity is high, workers will have more incomes, assuming that workers are paid their value, assuming that labor markets are competitive, etc. And if workers aren't paid quite what they're worth, managers and owners of firms make some of what those workers are worth. Those managers and owners of firms, they should also be able to consume goods and services. So the standard of living in both cases might be expected to rise as those workers become more productive. What we want to look at is what the determinants of productivity are, because we expect these to be the determinants of growth rates. If our productivity per worker is defined as Y over L, that's GDP divided by the number of workers that we have. One of the key reasons that a worker might be more productive is that that worker has more and better machinery, tools, and equipment to use. We call that physical capital. If a worker has more physical capital, then we're talking about a worker who's driving a truck as opposed to a worker who's pulling a cart with a donkey. Now, the worker who's driving a truck has a big, expensive piece of physical capital, and they're also able to carry a much larger, heavier load much faster than the worker who's driving a donkey cart instead. It's not just because of a difference in technology, but in many countries, because of a difference in investment in physical capital. These trucks are expensive relative to a cart pulled by a donkey. So we may have countries that clearly have the technology, they have the ability to either buy or build a truck, but nonetheless, there will be some workers still pulling carts with donkeys. Now, this carries over when we talk about construction workers with cranes, when we talk about construction workers with jackhammers. All of these kinds of expensive tools make these workers more productive. And on average, when we have more of this physical capital in all of the businesses that these workers are employed in, across the board in our economy, our workers will be more productive. We simply say, as the amount of physical capital in the economy increases, productivity per worker will also increase. So K, physical capital, divided by L, the number of workers, is physical capital per worker. And we say that physical capital per worker is one of the key determinants of output per worker, or productivity, Y over L. Next important reason that we may see workers more productive in one economy as opposed to another economy is not the physical capital, but the skills that these workers have. Skills and experience are also important for making workers more productive. And workers with more skills, more experience, more training, and more education have what we call not physical capital, but human capital. So physical capital is an investment in tools. Human capital is an investment in training. Now, a worker with more human capital is more productive than a worker with less human capital. But human capital means a lot of different things in a lot of different circumstances. But in general, it should mean that the same worker is either able to produce more and faster, or that same worker is able to produce the same amount better, producing a higher quality good or a higher quality service, which has a higher market value. So an increase in human capital for architects, for example, may enable those architects to design homes, design buildings more rapidly, or it may enable those architects with higher human capital to build better buildings at the same speed, to do their job better, producing goods which are better, therefore have a higher market value. And we call this human capital. If we can estimate some kind of total abstract quantity of it in the economy, we label it H. Human capital is H, physical capital is K. And the average amount of human capital per worker on our economy is H divided by L. That's human capital per worker. Now we would say that output per worker, or productivity, is determined by both K over L and H over L. Physical capital per worker and human capital per worker. Some economies, as compared to other economies, have greater stocks and stores of natural resources. Those natural resources may not always be critical determinants of productivity and critical determinants of standards of living, but where they do exist, they are important. To point out just first, Japan has very limited natural resources. Singapore has very limited natural resources. And these are rich countries with high labor productivity in spite of the fact that they do not have natural resources. However, Saudi Arabia is a country with high natural resources and also a high standard of living, where the natural resources that they have are the primary reason that the standard of living in the country, the productivity in the country, is high. Now, all else equal, more natural resources in the economy would be good. Countries like Japan and Singapore, with our current global economy, are able to get these resources from other countries, so they're able to produce even though they don't have them. But still, if they had them, they would be even better off than they are now, where they have a lot of human capital per worker and a lot of physical capital per worker. All else equal, if we have more natural resources, say more timber, we have more oil in the ground, we have more coal, we have more iron ore, all of those resources, more fish in the sea, workers would be more productive. We'll call those natural resources N, just like we called human capital H, and we called physical capital K. And then another one of our determinants of productivity would be N divided by L, the natural resources that are available to our workers in the economy. Now, as I said, the N is something we can largely do without, if necessary, in a modern global economy, because we imagine that N can be obtained from other countries through trade. If we were to imagine that we were looking at a country that could not trade, or we were looking at a period in time hundreds of years ago when trade was much more expensive and less likely to occur, N would become disproportionately more important. So we may have some countries that got a head start on growth and development due to the existence of resources during a period in time when resources per worker were very important, such as coal in Britain in the 18th century. Now, the last of our determinants of productivity is, as mentioned back in the first lecture about this specific principle of economics, what we call in economics technology. I'll explain again, technology in economics doesn't quite mean what technology means anywhere outside of economics. Technology is generally referring in economics to the way the production process is organized. Now, this is industrial organization or industrial engineering. This is process technology and process innovation, as opposed to the invention of some kind of a new product. Now, when we have in a particular economy a high level of technology, then we say businesses are very well run and very well organized. And because they're very well organized, workers at those businesses are able to produce a lot of goods, or able to produce very high quality, high value goods, and more than they would be able to produce in a different business, in a different country, where the business was less well organized. Not because the worker themselves have more skills or because they have more machinery to use, but because the business is well organized and efficient. So further, one of our determinants of productivity is technology. We might call technology T, or we might leave it out entirely. Now, to contrast what we mean when we say human capital versus what we mean when we say technology, when we talk about human capital, we talk about the skills and training that a worker has, which could be the skills and training that managers and industrial engineers have. When we talk about technology, we talk about how a business is organized. Now, workers and managers that are very skilled and educated, they may be able to figure out better ways to organize those businesses. So we can make the argument that having a lot of human capital might improve your growth rate in technology over time, leading to further future increases in productivity. It's another reason that we like human capital, argue that human capital is important for economic growth. Now, we can quantify or codify this relationship between output or between productivity and these various determinants by looking at an estimate for an economy-wide production function. That's how, through our economy, these inputs that we use are used to produce goods and services, somehow converted into goods and services. Our production function for the entire economy would be Y, output or GDP, as a function, that's where the F comes in, of capital, of labor, of human capital, and of natural resources. So what's that A that you see there in that equation? That A is technology. We assume that technology could be expressed in this functional form as a scalar. So technology doubles. Then with the same amount of capital and the same amount of labor, the same amount of resources and human capital, suddenly with double technology, we would be able to produce double the amount of output with the same inputs. Now, this is the production function that enables us to produce total GDP. But it isn't productivity. To get productivity, we want to convert this production function to a per worker scale. So divide everything in here by L. So Y over L is now a function of K over L L over L, H over L, and N over L. What's L over L? Well, L over L is just 1. L over L doesn't mean much of anything. We'd say now, output per worker is a function of capital per worker, human capital per worker, natural resources per worker, scaled by this technology parameter. Now, technology isn't something that we can estimate in the same way that we can estimate an amount of capital and say that we have a certain amount of capital in our economy, which we know we have because we've calculated the value of all of these buildings and all of these machines. Technology we have to estimate through econometric statistical techniques as a residual. We're just guessing what it is, and we say that if with the same number of inputs we're able to produce 10% more, there must have been a 10% increase in technology, because that's the only thing that could explain it. If that increase in output or productivity can't be explained by human capital per worker, or capital per worker, or natural resources per worker. Now, if this is our production function that determines output in the economy, or this is the production function that determines productivity in the economy, what key features do we expect realistic production functions to have? Well, first, we expect these realistic production functions to have diminishing marginal returns to any one of these inputs. So our production function should have diminishing marginal returns to capital. If we simply add more and more and more and more capital into our economy, but we don't increase the amount of labor or human capital or natural resources, then we should expect a diminishing return to the capital that we add. That is, it will have a positive derivative but a negative second derivative, diminishing marginal impact of additional capital. The same would be true for labor. If we just add more and more and more labor into our economy, but we don't increase the amount of capital, and we don't increase the amount of human capital, and we don't increase the amount of natural resources, just by adding more labor, we would decrease the amount of capital per worker, and human capital per worker, and the amount of natural resources per worker. So simply adding more workers into our economy would make each worker a bit less productive, and giving us a diminishing marginal return to that additional worker. The same would be true for human capital if we added only human capital, or natural resources if we added only natural resources. However, the other feature that we expect this function to have for a realistic kind of whole economy production function, not necessarily the same as the production function for a single tomato farmer, and not necessarily the same as the single production function that we might have for, say, a cell phone service provider. But for an average production function for our whole economy, we expect it to exhibit constant returns to scale. What that means, for us to have constant returns to scale, is that if we were to double each of these inputs, it would work in the same way as for our individual firms' cost curves when we talked about constant returns to scale, where we could simply open another identical restaurant or open another identical factory and double our output without increasing our costs, without decreasing our productivity. So here, if we go in a function with constant returns to scale from K and L and H and N producing Y, if we then go to 2K and 2L and 2H and 2N, we should, with constant returns to scale, be able to produce 2Y. So these are the basic expectations that we have for our constant returns to scale production function. Next, what we want to look at is how public policy, government economic policy, might be able to influence some of these determinants of economic growth. If governments can influence long-run productivity trends, either by influencing capital per worker, or human capital per worker, or natural resources per worker, they could potentially increase economic growth and improve standards of living in the long run. Now, first, in our economy, we'll get into this more in a future lecture. For us to be able to invest, we need to have funds, we need to have money to invest with. An investment in our economy means building more K. If we have a certain amount of money, we could either use it for C, consumption, or we could use that same money for I, investment. And for us to be able to have that money to use for investment, to build more physical capital, therefore increase that capital per worker over time, which makes our workers more productive so that our workers could be paid more over time, we're going to need to save more. Because for us to invest, we have to not consume. And money that's not consumed is saved. Saving is going to be reallocated through the financial system to investment, even if they're not originally saved by the same person that would like to invest in that physical capital. So for us to reduce consumption, to increase saving, a government could do something to incentivize. Perhaps the government could reduce the tax rate that's charged on interest income for money that you put in the bank to incentivize you to save more. Or the government might say, make certain pension savings out of your paycheck mandatory to force you to save more, or to make them opt out instead of opt in, so that most people might by default save because they never take the trouble to decide not to. Now, if the government tries to incentivize saving, this also, as I mentioned, means reducing consumption in the short term. But there's a reason to it nonetheless, even though we'll consume less in the short run and therefore kind of have lower standards of living in the short run, is that we hope that our economy, because we save more and invest more, will grow faster. If our economy grows faster, then we'll have higher standards of living in the future, and we'll have higher ability to consume in the future. So when individuals save, they're trading current consumption for future consumption. And the government might try to influence them to save more, therefore sacrifice more current consumption in exchange for more future consumption. It's not necessarily clear to all economists, based on their economic modeling and theory, that the government should in fact try to convince people to save more, even though it would mean that the economy would grow faster. Some economists would argue that people choose not to save more because they would rather have things now than wait and have things in the future. And this is the reason why they don't save, why they can't invest, and why the economy doesn't grow faster than it does. And they would argue that the people in the economy would be less happy, less satisfied with rapid growth rates coming from high investment because they wouldn't have very much to consume in the short run. Now, high rates of saving leading to high rates of investment that go along with relatively low consumption in the short run, which could mean hardship in the short run, are exactly what has enabled China to grow so fast since 1970. China has a tremendously high savings rate and investment rate at approximately 50% of the economy. So since 1970, that amount of physical capital per worker in China has been increasing very rapidly. And that physical capital per worker in China is now similar to what it is in high-income countries. We should also mention that if a government tries to incentivize saving, or if a nation grows very rapidly over time because of increases in capital due to investment saving, there will still be a diminishing marginal product of that capital. As we increase capital more and more and more without increasing labor, or without increasing human capital, without increasing natural resources. China may find, for example, that as they invest in more and more physical capital, the return to that physical capital is decreasing. There's a lower marginal product over time. And they may at some point reach a point when it's not possible for them to continue to accelerate growth through investment alone, investment in physical capital. Japan would be an example of a country that seems to have hit this point, where the government has tried to stimulate economic growth by increasing investment, but it has not led to very much extra growth at all. because of this diminishing marginal product of capital, leading to the new capital not being very productive at all. This factor, that it's possible for a country which initially has a very low level of capital per worker, such as, say, China in 1970, to get a relatively high return on new capital investments as they invest more, stimulate more investment through policy, perhaps. Because they can get so much higher return on new capital investments than a rich country has, they may be able to grow more rapidly through capital investment than a rich country possibly could. So poor countries, countries with a low level of capital per worker, have a greater opportunity to grow at a rapid rate, to catch up to rich countries, something that rich countries can't do. But the closer they get to those rich countries, in the total amount of capital per worker that they have, the more they've exhausted those potential opportunities to increase growth, increase output through capital investment, the lower the return on capital becomes, and the less opportunity they have for this catch-up effect to drive growth. As another example of this catch-up effect, if we have two countries, a rich country and a poor country, a rich country and a middle-income country, and those two countries spend the same proportion of their GDP on saving and investment, what we would see is that the middle-income or poor country would grow at a much more rapid rate than the rich country did. They would catch up because the capital that they were investing in was much more productive than the capital that the rich country was investing in. But over time, as they came closer and closer and closer in GDP per capita, in productivity to the rich country, the productivity of those new capital investments that they make would come closer and closer to the productivity of the capital investments made in the rich country. The catch-up effect would die off, and those countries would begin to grow at approximately the same rate once their capital per worker became approximately equal. Next, another way for a country that isn't able to stimulate savings in order to stimulate investment, to increase the amount of capital per worker, and therefore worker productivity, would be to attract capital from other countries. When we attract capital from other countries, we call this foreign investment. It can be either foreign direct investment, if foreign companies are building factories in our country, or it can be foreign portfolio investment, if foreign companies are buying existing factories or buying ownership shares in existing factories in our country. Both should have similar effects, but foreign direct investment may be more stable over time, and foreign portfolio investment may be more volatile. There may be more of a risk that foreign portfolio investment may suddenly disappear due to some kind of an external shock to our economy. As a result, most economic policymakers prefer foreign direct investment if it's something that they can choose. Now, of course, some of the returns to this foreign investment as capital, the return to that capital goes back abroad. So this isn't quite as good for the economy as if this capital investment came from within. Nonetheless, by increasing the amount of capital that we have in the country for our workers in the country to work with, we are increasing K over L, and we increase worker productivity. And it may be easier for us to attract a very large amount of foreign direct investment or foreign portfolio investment in a relatively short time through policy incentives than it would be for us to encourage additional saving by people living in the country so that we have more of our own funds to invest. The argument is also made, in the case of foreign direct investment, that there may be a learning by doing, a learning benefit to foreign direct investment. That by building this factory with foreign technology, that is to say, a technology which is in management, a technology in business organization, which is that of the foreign country rather than our country. The foreign country has better technology. Our workers and our managers, people in our economy, can learn from that technology, learn from how that business, that factory is organized, in order to better organize other factories, other businesses in our economy, and improve our technology. Well, that doesn't mean because we're improving our technology because of foreign direct investment that we suddenly now have cell phones and we didn't have cell phones before, or we have automobiles instead of donkeys. That's not what we mean by technology. We mean how the business itself is organized. Next, a government that wants to encourage economic growth by making workers more productive can target not K, but H. We could increase worker productivity by increasing K over L or by increasing H over L. And we generally try to target H over L through education programs. Say, one method that's been used in some poor countries to try to incentivize education for the young where it's most valuable. But the marginal productivity of that education is highest for children who are younger rather than children who are older. And one way to incentivize them has been to provide meals at school, particularly in poor countries where what a family might be considering is whether they can afford to send a child to school rather than working. The fact that they can be fed at school and you don't need to feed them at home may be all it takes for it to become worthwhile to send a child to school or keep the child in school. And if in school the child learns to read, a literate rather than illiterate factory worker may be much more productive. Now, in more advanced economies, middle income or high income countries, what we tend to see as additional educational investments is often more along the lines of increases in spending for increases in enrollment in higher education. We have more people becoming industrial engineers. We have more people getting degrees in finance. We have more people getting degrees in education. We have more high-skilled workers rather than having workers with some skills, able to do very specialized jobs. Now, the returns to this aren't quite as large as the returns to early childhood education. As a result, we do see this diminishing marginal return to human capital investments, just like we do for physical capital investments. And just as in the case of Japan, it may be well the case that Japan has exhausted all the possibilities to stimulate growth through increasing capital per worker. We may also have many economies that have eliminated the opportunity to stimulate growth through increasing human capital per worker, because the average level of educational attainment in these countries is already so high. Exactly how many industrial engineers, how many electrical engineers do we need in an economy? And what happens if our industrial engineers are selling, say, paint in a hardware store, not utilizing the skills that we invested so much time and money to give them? Another way that the poorest countries can invest in human capital, that is, the skills, the abilities of individual workers, making those workers themselves more productive, is investing in health and investing in nutrition. Investing in nutrition for the young in particular, so that they are physically stronger and physically more capable to work, may increase productivity for low-skilled workers or unskilled workers at the very bottom of the wage spectrum. And it may potentially give, in very poor countries, quite a high rate of return. When we talk about investments in health to achieve the same thing, we may be talking about government's investments in health to make sure that workers are not sick, therefore are able to work or are productive at work. If we can prevent workers from contracting malaria, or we can prevent workers from contracting HIV, these workers are likely to miss far fewer working days, have higher productivity as a result. And when they're at work, they're likely to be stronger, more alert, and more productive as well. So some studies have found that in specific cases, particularly in the poorest countries, investments in health and investments in nutrition can do even more to improve worker productivity than increasing human capital in another way, through education and skills, or by increasing physical capital. The next way we could imagine that a government might try to improve investment, try to increase capital per worker, is through enforcement of property rights. A government could try to take action in a market where property rights are weak. Say, property right to land is weak. It's difficult to prove that you own it. Therefore, no one might necessarily have an incentive to try to improve it. or your right to continue to own and operate your business is weak, if a government can improve your faith that you will continue to own that business in perpetuity, they improve your incentive to invest in it. So they improve your desire to invest in more physical capital, where that more physical capital is required to improve capital per worker. Especially in the case of many African countries, the return to capital has been estimated to be enormous. 30%, 40% return on capital, far higher than the return on capital that anyone might be able to expect through investments in physical capital or investments in financial assets in the United States or Japan or the United Kingdom. And nonetheless, in these countries, like say Nigeria, we see capital flight. We see people who would like to save, would like to invest, sending their money to other countries like the United Kingdom and chasing a low return rather than investing that money in Nigeria, where the marginal product of capital is so high and the return on investment is so high. And the reason for that is that these people don't trust property rights in Nigeria, and they don't trust that if they make those investments, earning that high return, they will necessarily be able to keep that high return. And one result is that there is much less investment in physical capital in places like Nigeria than there otherwise would be or should be, based on the need for capital and based on the opportunities there to stimulate growth through investment in physical capital. And if the government was able, though the Nigerian government may not be able, to do a better job of protecting property rights, protecting an individual business owner's right to continue to own the business which they own and to get the return on the investments that they've made, that would enable them to stimulate capital investment and stimulate economic growth. Another type of policy prescription we might use that many economists have suggested to improve economic growth, stimulate economic growth, increase productivity, has been increased openness to free trade. Now, we established before there can be gains from trade, but it's much less clear whether we would or would not expect there to be long-term improvements in the growth outlook for a country as a result of openness to international trade. Nonetheless, we have seen that over the past 50 years in particular, there are a set of countries that have clearly grown rapidly while rapidly increasing their exports and also encouraging foreign investment in capital. So partly increasing their capital through foreign direct investment rather than through improving savings. It has allowed them to grow very fast, and perhaps faster than they could have grown if they were not as involved in global markets. We've also seen a subset of countries that are relatively less open to trade, relatively restricted, such as, for example, Argentina, that have not grown very rapidly over the same time span. But it's not entirely clear, like many other policy issues in economics, are not entirely clear whether this is or is not a strong causal relationship. We might be able to improve growth outlooks through openness to international trade, but it might not work too well at all. That isn't to say it would make us worse off, but it might not improve our growth. It might give us a one-off gains from trade benefit, just cause GDP to be higher, but not cause GDP to continually increase. Next thing that we might imagine that a government might be able to do to stimulate economic growth is through research and development. I mentioned that in particular for countries that already have high incomes, a country like Japan really can't do much to increase capital per worker in order to increase output. Many countries, like say the United Kingdom, can't really do very much to increase human capital per worker in order to increase productivity. Additional human capital just has such a low return if they don't also increase labor, capital, natural resources, that the only real opportunity for countries such as Japan, Singapore, United States, United Kingdom to stimulate economic growth, stimulate productivity, is if they can stimulate the A, the technology. if they can incentivize somehow businesses to find a better, cheaper way to make the goods that they make, to organize their businesses more efficiently. And we imagine they might be able to do that through at least certain types of research and development. So one thing that governments often do is to try to incentivize research and development spending by businesses in the same way that they try to incentivize capital spending, capital investment by businesses, by giving tax breaks, reducing the tax burden for those businesses that spend more on capital investment and spend more on research and development. One other factor that has a more complex relationship than you might assume with productivity changes and trajectory of economic growth is population growth. What happens to the population? There was one theory that was particularly prevalent a couple of hundred years ago, this Malthusian theory, that inevitably, because natural resources are either fixed or don't grow very rapidly over time, and labor grows exponentially as people reproduce, labor would naturally always be expected to grow more rapidly than natural resources, or more rapidly than the amount of land that was available for those workers. And Malthus felt that these natural resources would inevitably be stretched thin, and the amount of natural resources per worker, that N over L, would continue to fall and fall and fall and fall over time. Malthus believed, in a relatively extreme case, that because of this factor, any economic growth that we might have, any increase in productivity that we might have, would just lead people to have more children and for their children to be more likely to survive. And if that happened, the population would continue to rise and rise and rise again, and the standard of living would fall and fall and fall as the population rose, until the standard of living remained at a minimal subsistence level, which was the minimum level of consumption which was necessary to maintain the population. So we didn't have such a severe famine that more people were dying than were being born. Of course, since Thomas Malthus, we found that the population around the world has in fact grown and grown and grown and grown dramatically. Nonetheless, living standards have not declined. It may very well be the case that N over L is much lower all around the world than N over L was 200 years ago. We may in fact have fewer forests per worker. We may in fact have less coal in the ground per worker than we did 200 years ago. We may have less oil than we had 200 years ago, but we have much more human capital, and we have much more physical capital, and we have much better technology than we had 200 years ago. And as a result, we have higher standards of living despite a much higher population. Now, the other effect that we might see from an increase in population doesn't come about through spreading of natural resources, which might be fixed, but rather through spreading the capital stock. This isn't what Malthus had in mind. But if we spread the capital stock, then of course increasing L does, if capital doesn't change, decrease K over L. So increasing L without increasing K would decrease our capital stock per worker and productivity. But capital is something that we can build. It's something that we can make. We can invest in more capital. But if our population is growing rapidly, then we have to invest in more capital just to keep the same amount of capital per worker. And if our economy is saving 25%, no matter what, and investing 25% of all of our production, no matter what, for that same 25% saving and investment, if we have a higher rate of increase of labor, then we're going to need more of that investment just to give enough capital per additional worker. So some of that investment goes to new workers to give them the amount of capital that other workers in the economy already had, and some of that new investment in capital goes to increase capital per worker overall. So what we see is, for a 25% savings and investment rate, if we have high population growth, capital per worker grows more slowly. Therefore, productivity increases more slowly. Therefore, economic growth is lower. Or economic growth per worker. Remember, we're talking about per capita output, not overall output. Because of course, more workers are able to produce more stuff for overall GDP, but not necessarily per capita GDP. Overall GDP might grow faster. Also to note, the same idea that holds for capital, that for a fixed amount of investment that we have, we would require a lot of that investment just to give some capital to those workers just entering the labor force. The same holds true for human capital. The more rapid our rate of increase in labor, the more money we need to spend to educate all those new workers, to give them the same level of educational attainment, to give them the same skills, same training, etc., that other workers in the economy has. So it imposes a burden on our human capital investment, just like our physical capital investment. And for a fixed amount of human capital investment, say a fixed education budget for the nation, more rapid population growth means human capital per worker would grow more slowly. Therefore, productivity would increase more slowly. Therefore, GDP would grow more slowly. As a result of the latter, the idea that it's more difficult for us to grow through capital, grow through human capital investment, to increase per capita GDP, we do have many countries that have imposed regulations, imposed rules, imposed measures that are intended to reduce population growth, in part out of a desire to increase economic growth, such as China. China has imposed rules that force families to have only one child. Now, part of the reason for that is a worry about resources, this Malthusian concern. But a part of the reason for that was a desire to increase the rate of economic growth by reducing the rate at which capital and human capital per worker are spread. That's not to say that Chinese-type policies for family planning are desirable. But part of the reason that China has been able to grow so rapidly in terms of per capita GDP over the past 42 years may not just be their saving and investment rates, but also their low rate of population growth. Not all economists, I should clarify, believe that population growth is necessarily a negative for economic growth. Say that while yes, it may be true that we need to invest more to have the same growth rate in capital per worker. We need to invest more to have the same growth rate in human capital per worker, and this does act as a brake on economic growth. It may also be the case that for a nation, or especially for the whole world, there could be other desirable effects of larger populations that help to outweigh that. One thing, if we have more people, we might have more scientists and more engineers and more brilliant people and more new ideas. So they argue that maybe as our population grows, either in a larger country or a larger world population, maybe we have a more rapid increase in this rate of technological change. Maybe A increases, and if A increases enough to offset the negative effects that population growth has on K and H, maybe that's part of the reason why we've had so much population increase over time, but that Malthusian implication that we should expect immiseration, just subsistence level, no matter what our productivity temporarily became, was not met. And it's an open question for governments, for nations, and for economists whether natural resources are currently for some countries a limit or a brake on growth, as they certainly would have been 100 years ago or 200 years ago. 100 to 200 years ago, moving natural resources from one country to another was much more expensive, and trade between countries, if those countries were unfriendly, was much more difficult as well. So countries 100 years ago or 200 years ago might have felt that they needed to get access to resources, for those resources to be theirs in order to be able to use them. And clearly, they have had to use them in order to grow. Now, as we move forward, it's not just a question regarding natural resources, whether a country has access to them, but whether they exist in large enough quantities at all. Whether we might, as a world, run out of oil and not be able to buy it from some other country because it's all gone. or whether as a world we'll have enough of cobalt and other types of rare earths that are used in high-tech manufacturing. And as far as this is concerned, the jury is out. Economists do not agree. That one school of thought is that if a particular resource becomes so scarce, its price will become very high, and as its price becomes very high, it will incentivize some kind of research to find a way to do without it, to find a way to use something else instead. For example, in the 19th century, coal was the dominant fuel. We would have had a difficult time imagining that we could have continued to produce and sustain economic output if coal were to run out. Now we move ahead 100 years, 150 years, we still have coal in the ground. We're not worried that it will run out like people might have been in the 19th century. We're wondering whether we will want to use coal in the future, because we moved from coal in large part to other petroleum fuels like diesel. It became more efficient at the time, natural gas. And now we're moving into ever cheaper renewable energy sources, such as wind power and solar power. And it's an open question whether 50 years from now, solar and wind power will be so cheap that no one finds it worth digging coal out of the ground. Another school of thought would argue that for some certain resources, we may simply not be able to find a substitute, even if the price becomes very high. And for those resources, if we simply can't find a substitute, the price becomes very high, we're not able to consume very much, and our standard of living will be reduced. It may not affect our GDP in the same way that it affects our standard of living if the value of that output is high. One example might be, for example, fish. We might not have an easy time finding a substitute for fish in the sea as we begin to run out of that resource. Something we might never have considered 200 years ago, but now looking 30 or 50 years into the future seems to be becoming an increasing possibility.